Hi everyone, thanks for choosing FAL Consulting for your educational needs. This lesson will introduce the concept of cycles in financial markets with a specific focus on cryptocurrency market cycles. So here's an overview of what this lesson will be about. So we will discuss and define what market cycles are and how to identify them, what a bear and bull market is and how that relates to the greater market cycle, what market capitalization is and how to measure it. We'll also touch upon what Bitcoin dominance is and how that relates to what part of the greater crypto market cycle that we are currently in. And we'll discuss what alt seasons are. So let's start off with what a market cycle is. So market cycles are trends or patterns that emerge during different time periods. Market cycles can be measured as the period between two highs or two lows of a market. A cycle time frame can differ depending on what trends a person is looking for, whether you're looking if prices are constantly going up or are constantly going down. It really depends on the context of the situation. Now, market cycles generally have four main phases, and it can be difficult to accurately pinpoint what part of the cycle we are currently in. And it's important to remember in cryptocurrency, different coins will respond differently to different stages of a market cycle. And we'll dive into each of these topics more in a little bit. So here's a basic example of what a market cycle would look like. Starting from the bottom left, here we might see prices rise and hit a peak as seen here. And then we might see a decline in prices or a recession in prices falling down to a bottom. And then maybe prices may begin to reclimb back to the upside where we see a market recovery. And the cycle continues until we see a new peak, and then a new fall or new recession, new downtrend to a new bottom, and then possibly a new recovery and uptrend to the upside. And this cycle will continue back and forth. Now, cycles in traditional markets. So market cycles in the stock market take place over longer periods of time compared to cryptocurrency cycles. Cryptocurrency cycles are typically much shorter. We'll take a look at an image on the next slide, which will show cycles of the U.S. stock exchange, starting from the Great Depression in 1929 to 2017. And the most recent lows of the cycles were in the year 2000 and in 2008, which can be attributed to the dot-com bubble and the subprime real estate market crash. An important takeaway from studying market cycles is the reality that a market slowly ascends on the way up, but can quickly fall on the descent. So here's the image. This is an image of the S&P 500 index. This is essentially an overall market view of, let's say, the top 500 companies or stocks within an index, and there's an index created that tracks this and essentially can be used to track the overall stock markets. Here we see a bull market in the 20s. This is essentially attributed to the post-World War I era and a resulting decline. This was the great stock market crash of 1927 and would ensue the Great Depression. This lasted about 2.8 years, and we saw about a negative 83.4% loss in overall market valuation. Now, resulting from that, towards the late 1930s into the 1940s, with the industrial boom from World War II and the wartime economy, we see an overall increase over the next 14 years or so. And this was fairly prolonged, where there was about an 815.3% total return, about 17.2% annualized over the next 14 years, give or take. Then we see a short drop, or a short bear market in the post-war era, going into the late 1940s, early 1950s, and then an ensuing bull trend or an uptrend over the next 15 years. Here we saw 935% total return if you bought the bottom here and then rode it up to the top, about 17% annualized percentage returns. Now this trend continues through different periods. We saw specifically in the 1970s, which was known for inflation and higher oil prices. We see specifically longer periods of these downtrends, almost mimicking the extended period seen in the Great Depression, but not quite as severe. And this trend would continue. Most recently, if we take a look at this market cycle here, this is from the late 80s up into 2000 or so. This particular cycle was fueled by the growth of the internet and the internet usage in the 90s, websites and online payment services essentially dominating the market, technology companies overall seeing tremendous amounts of growth over about 13 years, where we see 816% total percentage returns with about 19% annualized returns. This essentially came to a halt with the dot-com bubble burst in the early 2000s, and can also be attributed to certain macro effects such as wartime and events with September 11th and the U.S. going into war. These events all certainly had a role in the resulting downtrend as seen here. Resulting that we see 5 years of an uptrend or a market cycle to the upside, 100%, 108% total percentage returns, 15%, and then a resulting crash. And this essentially can be attributed to the subprime mortgage crisis that we all know in 2008. Now let's talk about stages of a market cycle. So market cycles can generally be split into 4 different phases. You start off with the accumulation phase. Accumulation happens after the market has bottomed out and prices are starting to stabilize and build to the upside. There's the markup phase. This phase happens when the market reaches a point of stability and starts moving even higher in prices. There's the distribution phase. This occurs when the asset begins to reach its peak and sellers start to dominate. And then the downtrend. Downtrends occur when the asset price falls. Now, to simplify things, we can also think of these cycles divide them into 2 different phases: a bull market where the price moves upward, and a bear market where the price moves downward. The reason why we call it a bull market is because bulls thrust their horns upwards to the air, and this would encompass the accumulation and market phase and part of the distribution phase, whereas bears swipe their paws down. And essentially, a bear market would encompass the later half of the distribution phase. As we see, prices start to decline. The markdown part of the market cycle and the beginning of the accumulation phase. Now here's an example of what this would look like in crypto. So here is a chart looking at Bitcoin to the US dollar. This is a daily chart. So here we see an accumulation phase starting in about September 2020, July 2020, and this is the most recent Bitcoin market cycle. We saw an accumulation phase. Prices are starting to stabilize and slowly trend upwards. Towards the later half of 2020 into early 2021, we see the markup phase where prices start to stabilize more and increase to the upside in more dramatic trends. Right, we're starting to see these sharp peaks to the upside. Finally, we reach the distribution phase, which essentially is the market top of the market cycle. Prices begin to reach their peaks, and the dramatic growth that was seen in the markup may even start to slow down. We're starting to see less of these extreme pumps to the upside. Following the dramatic peak of the distribution phase, we will start to see some declines and lower highs, and then finally a markdown phase where the market essentially cools off into a new cycle to begin. So let's talk about bull markets. So a bull market refers to an uptrend in the prices of a market. This strong uptrend correlates to meaningful rising prices over a specific period of time. We're starting to see higher highs, higher lows. The market is overall moving up. Now, a bull market can make up the end of an accumulation phase, the entirety of the markup phase, and the beginning of the distribution phase. In traditional markets, the term bull market is often used when the price of an asset increases 20% or more from its previous low point. And the volatility of cryptocurrency markets results in dramatic price action during bull markets, where the price of a coin can dramatically increase over a short period of time. Coins increasing in value anywhere from 20% to 100% in a day is not unheard of. And at the time of recording, we are currently in a bull market, and it is fairly common to see certain lower value coins all of a sudden just shoot up in value, where they'll increase over 50% in the middle of the night. Now, here's another example of a market cycle, specifically focusing on some of the emotions that may take place. And any investor or market trader will have some experience to a certain degree with these emotions because everyone experiences them. So starting in the beginning of the market cycle, this accumulation phase, there's some hope where investors think a recovery is possible. And then there's also some disbelief at the same time, where they think this rally will fail like the others. As we enter the markup phase, optimism begins to grow. There's more investor confidence that the rally is real. There's greater belief that the asset is going to keep moving, it's going to keep growing, and this is the time to get fully invested. And during this point, we'll start to see more newcomers to whatever market asset space enter the field. Retail investors that may not have had certain experience with markets may begin to enter, and you might see them more on messaging boards and social media. And there's also a sense of thrill and euphoria when you start to see your investments compound and grow, and you start to see them double, triple, quadruple, or even higher over the course of maybe a few months or so. And then as we get to the distribution phase, there's a sense of complacency. Markets do not consistently just keep going up. There's always a cool-off point. And when we start to see lower highs, that's when we start to see the sense of complacency, where people may think we just need to cool off for the next rally. As the markdown phase ensues, we start to see feelings in general market environmental thoughts such as anxiety, denial, and panic. Why are these dips happening? Why is the price going down? And then overall, we get towards the bottom. People might be angry, maybe even depression may kick in. And it's important to understand that these market cycles are continuous. Markets go up, markets go down. And eventually, the market will go back up. It might not happen in a few months, but it might take a longer period of time. Moving on to bear markets. So a bear market refers to a downtrend in the prices of a market. This strong negative trend results in significant price descent or decreases over a specific period of time. Now, a bear market can make up the end of a distribution phase, the top of the cycle, the entire markdown period, and the beginning of the accumulation, which is the bottom. A downtrend can result from decreasing investor confidence in the overall market and overall coin performance. Pessimistic or negative market sentiment can result in increased sell-offs by investors, triggering even more sell-offs and more price reductions. Essentially, people see prices going down, they won't want to lose money, they might be prompted to sell, further causing the price to go down, and essentially it's just an endless cycle until the price bottoms out. Now, in comparison to traditional markets, crypto markets can see more dramatic and longer bear trends where 50% or higher price drops are not uncommon. Here are some examples of previous market cycles, and this is the Bitcoin chart. This is specifically looking at the 2013, 2014, 2015 cycle, where we saw in mid to late 2013, we saw a dramatic bull market, a dramatic increase in prices. From around in July, the price was just about $100 per Bitcoin, and it reached a high of nearly $1,200, $1,200 per Bitcoin. The resulting downtrend saw Bitcoin fall from $1,200 all the way to lows of about $250. So if you were to have bought the top, essentially, that would have been a fairly dramatic loss. Looking at the next cycle following the 2014 cycle is the 2017, 2018 Bitcoin cycle. So here we see Bitcoin overall gradually increase over the course of 2017 and really start to heat up and dramatically increase towards the end of 2017 into early 2018, going from lows of about $2,000 per coin to a high of about $19,000 per Bitcoin. The resulting downtrend saw Bitcoin fall from about $19,000 to about $4,000. And this market would continue throughout 2018 and into 2019.